Hi there. Welcome to The Street on BNN Bloomberg. I'm Lindsay Biscaya. On the show today, Brooke Thackeray, research analyst at Global X, is our guest co-host. Then coming up at 8:30 Eastern, Veronica Clark, U.S. and Canadian economist at Citi Research, is here to help us break down the November Consumer Price Index. And we want to hear from you this morning on First Call. You can call us with your questions on North American large caps, and we'll have Brooke Thackeray answer as many of them as he can. The number to call will be 1-855-326-6266, and you can also email us. Our email address is firstcall@bellmedia.ca. And now here's some of the stories we're tracking for you in the BNN Bloomberg newsroom. Home sales across the country saw a decline last month, along with home prices. Data from the Canadian Real Estate Association indicates national sales fell 10.7% in November compared to the year before. Home prices, meanwhile, fell 0.4% month over month. The association says housing activity has turned into a holding pattern heading into the new year, adding that continued trade tensions with the U.S. have weighed on buyers' confidence. New listings also saw a decline in November. And shares of Canopy Growth are seeing a rise in the pre-market trading today. The Canadian Cannabis Company will acquire Quebec-based MTL Cannabis. The transaction is valued at $125 million and represents a premium of around 45% to MTL's 20-day average price. Canopy says the deal is aimed at strengthening its medical cannabis business and boosting capacity to serve growing international demand. And now our top line story. Home sales in November dropped almost 11% compared to the same month last year. The Canadian Real Estate Association says U.S. trade relations are still weighing heavily on the minds of potential buyers. Let's bring in our guest co-host, Brooke Thackeray, research analyst at Global X, with more. It's good to have you today. Thanks for joining us.
Oh, thank you very much.
So what do you make of these numbers? I mean, year over year down almost 11%. New listings also down. Are you surprised at all?
I'm not, actually. I mean, we've seen some erosion in real estate across the board in the States, and also we're seeing it in Canada. This is a bit of a continued trend, and the numbers have been moving back and forth. We've seen a lot of waiting for interest rates to go down as well. And, well, right now, according to the Bank of Canada, the probability of them cutting rates over the next year is zero. It's expected they might actually hike later on in the year, according to the futures markets. So we've seen homeowners waiting for that interest rates to move lower, and that's not happening anymore. So I think right now it's a lot about the affordability index that's taking place with consumers as well.
Even with a couple of rate cuts over 2025, like still not really enough for a lot of buyers to maybe get into the market or get back in, I guess?
No, I mean, the Bank of Canada has been cutting to help stimulate the economy. And the economy's been slowing down a bit. The latest GDP numbers and growth numbers really haven't been that particularly strong. And so investors are a little bit, or consumers are a little bit uncomfortable. And home prices were stretched as far as debt goes, private debt, amount of income versus the mortgage rates, et cetera. And so it's extremely stretched. So unless we see a lot of erosion in interest rates, I don't see a big, huge pickup as far as real estate going. And that's not expected.
So interest rates are one part of it. I take your point that that's what you think we need to see for buyers to get back in. But there's also uncertainty around the economy in Canada. Like, do you think if trade relations with the U.S. were maybe to stabilize even further, we've seen kind of some stability a little bit, but heading into 2026, do you think that might change things as well in terms of the housing market in Canada?
Yeah, I think the trade relations with the U.S., I think really that translates back into the employment picture. Are people really concerned more about their job? Are they going to be keeping their job? The unemployment rate in Canada went from 6.9% to 6.5% last month. But we actually lost full-time jobs and gained a lot of part-time jobs. So that wasn't really that healthy overall. But that's really what it comes down to. So there is a lot of uncertainty right now. And people in Canada feel uncertain about the economic future coming up. And so they're not going to make those big decisions as well to stretch themselves even further at this time. If they had a bright outlook for the economy on a go-forward basis, yes, I'm going to be keeping my job, et cetera, and everybody's going to be, economy's growing, we'd see perhaps a little bit of upward pressure on house prices, but that's just not the case. People are uncomfortable right now, and it's uncertain.
I think that's so interesting. Like you mentioned, people are worried about their jobs long term, because that was some of the data we saw come out. I think it was for the month of October for Toronto's real estate market, Vancouver's real estate market, Montreal's, is that people are worried long term about whether they're going to have a job. Like that's another big reason for holding off when it comes to buying a house or maybe looking for their next home. Is there anything the federal government could do, or the central bank probably not really, to ease those concerns at this point?
Well, I don't see the central bank doing very much, because they're not expected to cut interest rates, because otherwise they'll risk inflation moving up. The government of Canada, I don't want to get into all the political debate, but there is, they can help stimulate the economy by, I'd say, actually cutting taxes, providing some incentive for small businesses, medium-sized businesses to get going. I think supply-side economics, reducing regulation, so companies are able to start up and grow much faster. Canada has a lot of regulation around that. I think that those would be the key things to help the economy grow on a go-forward basis.
You mentioned the central bank, maybe not cutting interest rates, at least for the first half of 2026. There is something else I know you've been talking about with us, at least off camera, about the Bank of Canada announcing a program to start buying treasury bills from the government. They say this is not quantitative easing. Do you think it is?
Well, okay, so we're seeing in Canada, Tiff Macklem made that announcement last month, and it actually starts tomorrow. The Bank of Canada is actually buying T-bills, what they call a normal course, and they have done this in the past, to be fair, as part of the balance sheet management. And we saw Jerome Powell actually announced last week that the Federal Reserve is going to also start purchasing T-bills in the short-term market, around $40 billion a month. Is it quantitative easing? Yes, it is. I'd say it's QE light in the way. Now, the Bank of Canada is actually trying to manage the liquidity at the front end. They're actually buying them right from the primary auction, right from the government, which is kind of unusual. And it will grow the balance sheet over time. Now, they're saying that they're going to let off the longer-term bonds roll off as well. So it is a bit of management. I would still say it is a form of quantitative easing. If you're speeding, driving along, and an officer pulls you over, you say, well, you can't say, well, I was going to my daughter's baseball game or something. It doesn't matter what the reason is, you're still doing it.
Right.
So I would say it is quantitative easing. It's not expected to be like what we saw in the past. We saw the Federal Reserve do this back in 2019, and now they're doing it again. There's a big debate. Is this quantitative easing or not? I'd call it QE light.
QE light. Okay. All right. We're going to take a quick break right now, but we'll be back with more coming up right after this. Stay with us. Welcome back. Here's how things are shaping up on the markets. We'll start with the U.S. futures this morning. Take a look at how they're trading before the bell. Climbing amid bullish calls for 2026. We're also awaiting some jobs data this week in the U.S. that's coming out tomorrow, and you can see reflecting there pretty positively to start the morning. In terms of how major Asian markets finished the day today, you can see retreating. The Nikkei down by 1.3%, the Hang Seng down also 1.3%, and the CSI 300 down by 0.6%. Moving over to Europe, where those markets currently trading, awaiting a rate decision from the Bank of England later this week. You can see positive results over there to start the day, to start the week. The FTSE, the CAC, and the German DAX all up at the moment. If we take a look at where the TSX finished the day on Friday, it was down by 0.4% to finish the week last week. And if we look at some of the biggest winners and losers on the TSX on Friday from a percentage standpoint, We can see Curaleaf was one of the biggest winners of the week, up 37%, almost 38%. CAE Inc. also up by more than 5%. Celestica, though, down almost 13%. And Energy Fuels also down by more than 7%. And we'll take a look at the price of metals at the moment. Gold climbing, nearing another fresh record this week, up by 0.9% at the moment. Copper also rebounding after a sharp sell-off of metals on Friday. You can see silver up as well. And if we take a look at crude oil, oil steadying, still hanging around the lowest level in nearly 2 months. And we are back now with Brooke Thackeray, research analyst at Global X. And Brooke, you've been watching the technology sector, those tech stocks not looking as shiny as they once were. Why has the sector been underperforming, in your opinion?
Well, if you go back and take a look at AI, because AI has really been driving the technology sector, and there was this belief that AI was going to take over the world, and it's all going to be a smooth path of growth. Everything's going to be there, laid out perfectly. Mm-hmm. All of a sudden, that has come into question. Do we have enough power? Can we get the power to the data centers? Are there enough data centers? And what we're seeing is the hyperscalers really starting to borrow money. Before they were using their own cash for their free cash flow. And now they're actually borrowing money as well going forward. Like Oracle, last week we saw Oracle come out and they beat on expectations for their earnings, but they missed on the revenue. But they said, hey, we're going to borrow more money. And investors did not like that. So there's just a lot of questioning around the narrative. Yes, AI is going to change our life in the next few years, but it's not going to be a smooth path going forward. And there may be some hiccups and it may not be able to grow as fast. And on top of that, we have competition from China. They keep coming out with DeepSeek and DeepSeek 2 and other ones as well. Yeah,
I want to dive into all those points a little bit more because there's questions about the slow uptake when it comes to spending on AI, right? Like, is it slow in your opinion, or is it more the issue, as you say, companies are starting to borrow money?
Well, I think the uptake of AI is slower than expected as well. So in the technology field, they're picking it up really fast because that's what they do. But if you go to the average manufacturing company in industrial area, it's a slower process for them to do this. And so that rate of growth isn't as fast as what was expected. And you need to be able to finance all this debt by actually selling the product. And it's just not happening at the rate that they expected. So it's just one more question around this. So in the end, we're seeing this sector and technology overall lose a little bit of its shine.
And then you mentioned the competition as well, especially from China, right? Like, how big of a factor is that? Is that not the same situation in other countries around the world? Like, is spending a little bit faster? Are they building data centers, for example, a little quicker than we see over here?
Well, China builds things really, really fast.
Yeah. This is true.
No matter what it is, nuclear power plants, data centers, hospitals, everything. They build really fast. Yeah. So they can deploy really, really quickly. But they're using their own technology as well as far as AI goes, and even chips. I found it interesting last week when NVIDIA came out, and the US came out and said NVIDIA can sell their H200 chips into China. And NVIDIA went up, and then China came back and said, well, to the Chinese companies, you better be using our Huawei chips unless you have to. So you have to apply to use those chips. They're really trying to force their own industries as well. But as far as AI in North America goes, we will see more competition coming in. Not just the major companies. And even within America, I wouldn't be surprised to see other startups happen in AI, not just OpenAI. Well, we saw it with Google to start with. Google came out with their own TMU chips that were very powerful for Gemini. Then we saw it with Amazon. So we're seeing all of this. The narrative is being questioned at this point. And so I think investors are not as comfortable being in that space. And what I think it means for the markets is that we're starting to see a rotation out into other areas in the market. And I think that's good.
You do think that's good? Okay,
yes.
That's what I was going to ask, because we've seen the markets this year being driven up mostly by tech stocks, right? So you think it's good that investors are kind of going elsewhere? And where else are they going in terms of looking to invest?
So I think they're saying, well, where do we go at this point? I think some of the areas that they're really looking at is the commodity space. So we're seeing gold do well for a number of reasons. It's the precious metals. Some of the cyclicals are starting to come back as well. So I think it's now, I think for 2026, investors are going to have to start looking in other areas, not just AI, because that spectacular improvement in price for the big tech companies, I don't. Maybe they still go up next year. I'm not saying they're not going to go up, but I think they're not going to have that huge gain relative to the rest of the market. So we're going to see that investors looking into other areas, such as some of the cyclicals, industrials, materials, as well.
And I know we're going to talk about this a little later, but the small cap sector too, right? That could change.
Absolutely. I think that if we start to see investors move away from the Mag 7 stocks and some of those, I think these small cap stocks will benefit from that as well, as long as we have a healthy economy. And right now in the U.S., they tend to have a fairly healthy economy.
We have a minute left, so I just wanted to ask about Oracle because you mentioned that earlier. Like that story of Oracle beating estimates, coming out with really good latest earnings report, but then investors driving the price of the stock down. Is that the story we're going to see for other companies as well, other big tech companies, do you think?
Well, we saw Broadcom come out last week. So just for clarification, Oracle did beat their earnings, but they missed their revenue. And it was the revenue that investors were really concerned about. And we saw Broadcom come out and beat last week. But there was some funny stuff going on in their accounting underneath. And so we saw that stock get hit again. So investors are really being critical at this point and saying, no, we have to be really comfortable with this. You have to beat, you got to show a good future. Otherwise, we can see a pullback here. And I think we're at that stage where it's like you really have to show to move forward.
Interesting. Okay, we're going to take another quick break, but up next, we'll be back with Brooke Thackeray to see why ETFs are on his radar. That's coming up. Stay with us. Welcome back. It is time now for On the Radar, and we're back, of course, with Brooke Thackeray, research analyst at Global X. Okay, you've got a few ETFs on your radar this morning. We'll start with your silver pick, iShares Silver Trust. What is it you like about this one?
Well, I like the silver space in general. Right now, we've seen silver do extremely well. It's up over 100% year to date. Which is incredible. Gold's done well at the same time.
People don't talk about silver as much, though, about how well it's done.
They don't, because the focus is on gold. The central banks have been buying gold, but it just got out of whack as far as silver goes because it just was lagging for so long. If you take a look at the gold to silver ratio, and a lot of investors follow that, it at one time went up to 100. Gold was 100 times more expensive per ounce than silver, which is really at an extreme level versus historical levels. Now it's come back down to 69 because silver's done so well. So there's a couple things going on there. First of all, we have a shortage in silver. We need a structural shortage, and we need more silver. And we're seeing a lot of buying from retail investors of silver, physical silver and silver ETFs as well, particularly in the Asian markets. And that's really pushing the price up. And there's in the retail space, there's a lot of investors really trying to squeeze the price at the same time to move higher. So we have a shortage, demand's been increasing, and it takes a long time to bring on new supply for silver. So it's really the demand that's driving it at this point. And it's actually heating up. Now, I do want to say, a lot of investors will look at this and go, it's gone up 100% so far. That's too rich. And maybe it does come down. But commodities are different because they can just keep going and going and going for much higher than what you expect. I'm not saying that's going to happen, but just because it's gone up 100% doesn't mean it's going to pull back.
Interesting. Okay, next stock on your radar is Global X Defense Tech ETF. Defense spending has been a big topic of conversation this year, particularly in Canada. What is it you like about this ETF?
Well, for full disclosure, first of all, I do work for Global X.
Yes.
And I think this is a great space because we are seeing increased geopolitical tensions around the world. It's possible we could see a peace deal with Russia and Ukraine, and that would be a good thing. But I think that countries have still committed to increasing the amount of defense spending. Even if that were to take place, you would still see countries increase their spending. This isn't a peace deal comes out and we're going to stop spending. This is a long-term momentum strategy on a go-forward basis. And so I think it's actually a positive trend over the next few years. And on a seasonal basis, we tend to see the defense stocks actually, because of purchasing patterns, actually do very well in January and February. So I think we're at the right spot for that.
Interesting. There's also a lot of pressure right now, especially coming from the U.S. government for other countries to meet their defense spending targets, right?
Absolutely.
Which doesn't hurt an ETF stock like this.
No, it doesn't. And even if we did get that Ukraine-Russia peace deal, the U.S. is still going to be putting pressure.
Yeah.
And there's still the potential for other conflicts around the world as well, unfortunately.
Yeah, for sure. Okay, your final pick, State Street SPDR portfolio, S&P 600 small cap ETF.
Yes.
Tell me about that. I mean, we were talking about a little bit about the small cap sector earlier, but what do you like about this one?
So small caps, I think they've underperformed since 2021. So what you saw was after the whole COVID comeback, small caps did really well. But with the Mag 7, the big cap stocks taking over, really driving this market technology, we saw that really outperformance, that narrowing of breadth. And as we rotate back into a wider market breadth position, we're going to see the small caps actually start to benefit from that. So I think that's going to be one of the places when the market starts to broaden out here that's going to receive funds. And also as well, if we do see tech, as we talked about earlier, start to lose a bit of its shine and some of the money flow out of those sectors, then we're probably going to see some of that money flow back into the small caps. And as long as the economy is doing fairly well in the States in particular, because this is in the U.S., the small caps can actually do quite well.
Okay, Brooke, we're going to take a quick break with you for a moment, but of course you're sticking with us for the hour. We're going to switch gears quickly and talk about temperatures dropping. The weather warnings stack up. Thousands of people on PEI still can't count on cell service at home or on key roads this morning, and it's raising new concerns about how to get help in an emergency with every minute counting. CTV's Maria Saru reports.
Driving down some PEI roads, the cell signal starts to slip. In a worst-case scenario, that might make it hard to call for help.
I do driving patrols at night. It's not so reliable. We're trying to call the emergency number, trying to call 911. I've had that concern once before, trying to dial 911 for a medical emergency.
A recent cellular gap analysis across the island found more than 2,200 kilometers of road with no coverage inside vehicles. Another 800 kilometers plus with no coverage outside vehicles. But patchy service isn't just a problem for drivers. Nearly 7,000 civic addresses have no indoor coverage, and around 2,500 are dead zones outside.
If you got stuck on a dirt road or something like this and you have to walk a mile or more to get service, it's pretty hard.
I work from home, work in the basement, so sometimes just calls won't come through. I think it totally could be a safety risk.
The provincial government says it's committed $3.4 million into the improvement of cellular services. The first phase involves purchasing micro towers, which are more compact, that can be installed atop publicly owned buildings. Experts say adding more cell towers is a good way to fill gaps.
PEI is not that big. You can get good cellular coverage across the island with not that many microwave towers. It is practically possible to do.
The province expects the micro towers will be installed later in 2026 with stronger signals along roads like this one and at homes across the province. Maria Sru, CTV News, Charlottetown.
Still ahead, we are breaking numbers for Statistics Canada's Consumer Price Index data for the month of November with our next guest, and also our phone lines will open soon for our first call segment. You can call us. The number is 1-855-326-6266, or you can send us an email at firstcall@bellmedia.ca. We will be back in just a moment. Home sales across the country saw a decline last month, along with home prices. Data from the Canadian Real Estate Association indicates national sales fell 10.7% in November compared to the year before. Home prices, meanwhile, fell 0.4% month over month. The association says housing activity has turned into a holding pattern heading into the new year, adding that continued trade tensions with the U.S. have weighed on buyers' confidence. New listings also saw a decline in November. And shares of Canopy Growth are seeing a rise in pre-market trading. The Canadian cannabis company will acquire Quebec-based MTL Cannabis. The transaction is valued at $125 million, and it represents a premium of around 45% to MTL's 20-day average price. Canopy says the deal is aimed at strengthening its medical cannabis business and boosting capacity to serve growing international demand. And shares of Roomba maker iRobot are plunging in the pre-market today. That's after the company filed for bankruptcy and proposed handing over control to its main Chinese supplier. Its common stock will be wiped out under the proposed plan, which will allow it to remain as a going concern. iRobot has sold more than 40 million robot vacuums, but has been grappling with an earnings decline after COVID. The slowdown is due to supply chain issues and cheaper competitors. And we will take a look at the U.S. futures this morning, all looking positive before the bell. The Dow future up 0.4%, the Nasdaq 0.5%, and the S&P 500 up by about 0.4%. Statistics Canada just released numbers for Consumer Price Index for the month of November. The Consumer Price Index rose 2.2% on a year-over-year basis in November, matching the increase in October. Here to discuss those numbers and what it means is Veronica Clark, economist at Citibank, joining us with more. Veronica, good to have you. Thanks for joining us this morning.
Yeah, good morning. Thanks for having me.
So 2.2%. I believe most economists were expecting 2.3%, so a little bit lower than what most were predicting. What do you make of the 2.2%?
Yeah, it's not anything to read too much into. I don't think I was also right around 2.3, but it's a small downside surprise. It's really the details, when we dig into the details here that will matter more. What happens with services inflation, shelter, things like that. We did, of course, get these core measures also released at 8:30, and there has been some more slowing there. So it does look like some more positive signs of underlying inflation slowing.
So when it comes to the details, though, I'm not sure if you've had time to look into it. I was just trying to look while you were speaking. I know many were expecting gasoline prices to be the main driving factor here, food coming after that. Is that what you're seeing? Is that what you expected?
Yeah, I had a very brief look at the details also, and that seems to be what we see in this number. Those gasoline prices, that's never too surprising when we get this inflation data. We already have data on gasoline prices for the month. Unfortunately, as we're getting into the next 4 or 5 months, it is going to be harder, even in some of these details, to look at these inflation numbers, because if we go back to this time last year, we had all these tax changes, the sales tax holiday, the carbon tax removal in April. That does create these base effects for some of these components. So that those core measures really become, I think, a lot more important here.
Has the ongoing trade war with the U.S. or the tariffs that we're seeing really affected these numbers in any way, do you think?
It's very hard to point out. I'm inclined to think that there has not been much of a price impact. A lot of the price impact on Canadian prices, of course, would come from retaliatory tariffs that Canada has on the U.S. And there are some of those, but a lot have been lifted and changed over time. There were some surprisingly strong goods price increases earlier this year, really around the spring. Maybe that was some preemptive price increases, but I'm inclined to think there has not been a whole lot.
We know the grocery price inflation is now at its highest since the end of 2023. I mean, when we're looking at these numbers coming out today, how do you think that's going to affect consumer spending moving forward?
Yeah, no, it is absolutely, of course, a concern. That's something that people are spending on frequently. It's an essential spending item, and when you see higher prices there, it can have impacts on how you're perceiving inflation. Of course, how much you're spending on groceries versus other goods. Those do tend to be very volatile prices, though, and so when we want to see what the underlying trend of inflation is, you kind of tend to look through those food or energy prices. They can move around a lot month to month, but it does probably affect people's perceptions of the economy. Maybe you would see less spending on other goods if you have to spend more on groceries.
I know you touched on this, but when we're talking about the underlying factors, then if it's not gasoline prices, if it's not food prices, like what kinds of things are you looking at?
Yeah, so in the details of this inflation data, one interesting thing has been that there has been some stickiness in certain rent components, that rent component of CPI. It's been a bit out of line with some other industry measures on rents, certainly out of line with fundamentals of home prices that have slowed a lot more, housing activity. Of course, immigration, population changes have slowed a lot. That could mean less pressure on rents, but we haven't seen it in the official data yet. We'll dig into the details this morning and see if we start to see some of that. But I would expect the fundamentals of demand being a bit softer should mean that those rent inflation measures should slow too.
I know I'm asking you a lot of questions when you haven't had time to dig into the details just yet. But I mean, when it comes to how this might affect the Bank of Canada's decision on policy rates moving forward, do you think this will move the needle at all or change things?
Yeah, probably not this number today, but I do think we'll see more slowing in core inflation as we get into next year. And I think I'm a bit of an outlier on what I do think the Bank of Canada is doing next year. I actually do think they could be cutting more. They're certainly on hold for now. If we did see any dramatic shift in the labor market, maybe they would be cutting again. Certainly, we've had some stronger labor market data, but I actually do think that if underlying inflation is slowing, they do describe policy rates right now as on the accommodative end of neutral, and maybe policy rates, monetary policy can help support the economic recovery a bit more if you're not as concerned on inflation. So I do think if we saw more slowing in underlying inflation, they could be cutting again on that alone.
And in terms of these numbers this morning, like just before I let you go, is there some cautious optimism here in terms of what we're seeing, or like very cautious, or not so much?
I think that's fair. Yeah, we'll again see some of these details, but it's been a couple months now where those core inflation measures have slowed more. When we're trying to forecast this, there's a number of leading indicators of inflation I tend to look at. Things like how much are firms struggling to meet demand? Can they raise prices more because of that? And all those leading indicators do suggest that inflation should be slowing more. And so I wonder if we're starting to see that in the hard data the last couple months.
Okay, Veronica Clark, economist at Citibank. Appreciate you joining us this morning. Thanks so much for your time.
Thanks.
Still ahead, Debbie Su, the CEO of OpenTable, says consumers will continue to prioritize dining out and the overall restaurant experience in 2026. We will find out why after this. Also, our phone lines are open, and Brooke Thacroy is taking your questions on North American large caps this morning, so you can call us. The number is 1-855-326-6266, or you can email us at firstcall@bellmedia.ca. We'll be back in a moment. Welcome back. Debbie Su, the CEO of OpenTable, says consumers will continue to prioritize dining out and the overall restaurant experience. OpenTable is an online restaurant reservation service, of course, and she spoke with Romaine Bostic and Katie Grayfield on The Close about the dining trends expected in 2026. Take a listen.
I do think people want to go out. We've seen that year over year since the pandemic. People continue to prioritize the experience of dining out in their household P&L. I think that's one piece of it. People are craving connection. They want to be taken care of. And I think they want to support their local restaurants. I think all of that is wonderful. I also do think there's a part of it where, I don't, Romaine knows this. I'm not a great cook. I don't do it often. I did try during Thanksgiving. So, we went to the grocery store, we bought all the things. I was astounded by how much things cost. Mm-hmm. And so restaurateurs are so scrappy and innovative and resilient. And oftentimes we've seen, even with labor shortages, supply chain interruptions, inflation, they have not pushed that full cost that they're seeing onto their diners. Right. So oftentimes going out to eat could be a better deal. So I think it's both of those things.
Yeah, it's interesting. And you've seen that really across industries, not just in restaurants. Basically, companies taking on and eating some of the cost of those higher prices. But I want to talk a little bit about generational differences here, because I'm taking a look at the consumer segmentation breakout, and millennials actually plan to dine out 14 times a month. That is the highest of any generation. Is that usually the case, Debbie?
We haven't seen it be this high in one particular demographic, and it's funny because when I saw that stat, I was like, do I count in that? So I had to Google that and check. Yes, I indeed am a millennial. 14 times is very high, but if you think about maybe on the weekends, brunch, lunches, once or two during the week, and then a few dinners. If you break it down that way, it's not that surprising, and it's not actually that much if you think about, in your own life. But, I guess in some ways it does make sense, right? Millennials often have jobs, right, are of a certain age, have the resources to go out and dine out more frequently than perhaps those who are just starting, for example, in their career.
Well, I am curious also in this, you've been speaking of millennials. We'll just dig on millennials for a little while longer. 79% of them, according to your data, say the restaurant's, quote, Instagram TikTok worthiness matters in where they choose to dine. I'm not actually too surprised. I have a couple friends who are restaurateurs, and this is something they talk a lot about, is how much attention they have to put now into the decor and other non-food elements just to get people in the door. I assume that's been a trend that's been unfolding for some time.
It has been unfolding for some time. And I think if you talk to any restaurateur now, not even the ones who kind of grew up in the age of social media, they know that it's an important part of how diners are discovering them. So whether that be on TikTok or Instagram, but what diners want to know is it's not just, how your food looks in a photo. And it's not just about the ambiance of the restaurant, although all of those things, of course, are very important in contributing to a diner experience. But they want to know the story behind the food. Like, why did you pick this cuisine? Why this neighborhood? Why this size of restaurant? Like, I think that's what's really resonating. People want to hear the storytelling from the restaurants. And myself, right, because I didn't grow up with social media, it's been even astounding to see for Open Table how much people engage with our brand on these channels.
Well, I am curious about that, particularly with regards to your business, to Open Table's business. You've got tens of thousands of restaurants on your platform right now. I am curious, but we've seen some increased competition from places like Resi and Seven Rooms and a couple others that have cropped up here. How do you make sure you keep people engaged? I mean, obviously you have to get the restaurants on the platform, but how do you keep the average consumer engaged, not just to come to your site to book, but to actually do a little bit more?
There's a lot of things that we do, but first and foremost, what we do is we are a platform for our restaurant partners. We promote and tell their stories. I always tell the company, it is not our job to be cool. Our restaurants are cool. Let us be a tool in which that they can tell their stories.
That was Debbie Su, CEO of Open Table. Well, still ahead, we are looking at notable calls in the energy and mining sectors. Stay with us. That's next. Okay, let's take a look at some of the notable analyst calls and recommendations in energy and mining today. In upgrades, National Bank financial analyst Maxim Sytchev has raised the recommendation on Atkins Realis to outperform. The price target now set at $110, implying a 28% increase. And a few initiations to note now. TD Cowen has initiated coverage of Atex Resources with a buy rating. Price target is set to $4.25, implying a 49% increase from last price. Citi has initiated coverage of Lundin Mining with a recommendation of a buy. That price target there is set to $32, implying a 17% increase from the last price. And Citi also initiated coverage of Hudbay Minerals with a buy rating. That price target set to $31.68, implying a 23% increase from the last price. And then finally, downgrading BMO Capital Markets analyst Randy Ollenberger cut the recommendation on Imperial Oil to market perform from outperform. Now, the price target is set to $129, implying a 2% increase from last price. So for more on all of this, we're going to bring in Brooke Thackeray, research analyst at Global X. He's joining us this morning. Thanks for still being here. I'm not sure if there's any of those stocks or companies that really jumped out to you, or any sectors in particular that you're kind of watching or that you like in terms of energy, mining, nuclear. Anything of interest there for you?
Well, actually, I was listening to all those calls, and I don't want to take the easy way out, but I actually agreed with all of them.
You do?
I was going through, I think that's a great spot. I totally agree with that one, and I agree with that one. Usually I disagree, so it's kind of interesting. But if we take a look, Atkins Realis, I think they're in a great space. They're going to benefit from the whole build-out of the infrastructure, whether it's nuclear, power, et cetera, on that in Canada, as far as that money that's being committed to that space. So I think they're in a great space for that to start off.
Well, and that's the thing, like Canada has such a big role to play, right, when it comes to nuclear energy. What's the future, do you think, for nuclear energy?
Well, I think the future for nuclear energy is fantastic.
Yeah.
It's going to be there. It's just going to take a long time to get there, because it's going to take 10, 15 years sometimes to build nuclear power plants. And Atkins Realis, they'll be involved in the design phase, which would be the early part of that, perhaps as well. So as far as the infrastructure that supports the nuclear facilities, But I think the nuclear space is fantastic. The problem is with nuclear is that unless there's really hot headlines, we know the demand is, we know we have a deficit for nuclear power coming up. We know that, especially with what's happening with AI and data centers. But investors are going, well, or the utility companies are saying, well, they're playing chicken. They're still buying on the spot market a lot. And investors just aren't that interested in the space yet. And I think there will come a time where that's going to change. I don't know if it's going to be 2026, 2027, but at some point they're going to say, wow, we really have a shortage of nuclear power and drive that sector much higher.
Interesting. Okay, well, Atex Resources, a buy by TD Cowen. This is a copper and gold mining company. You agree with that one too then?
I do. I think that's fantastic because I think gold has a good long-term picture here. There's continued buying by central banks. Asian retail market's huge for gold, like it is for silver. And we're seeing a lot of central banks in Asia and even in Eastern Europe buy a lot of gold. And it hasn't really happened in North America yet, that whole excitement. Yeah, we keep hearing about the gold price. Perhaps it's an all-time high today or tomorrow.
Yeah,
it could.
Maybe.
But investors are still focused on that shiny ball technology. So they really haven't started to focus on gold so much. Copper's been doing great. Once again, because we're seeing that shift into the commodities. I think that whole commodity complex, I think, is we're just warming up at this point. So I think copper has a great run going forward from here.
And it's something that's really needed when you talk about tech, AI, like building up a lot of the infrastructure for AI. Copper is a big component of that.
Oh, absolutely. As far as the data centers go, the whole communications with the lines, with the power, et cetera, we absolutely need more copper. And you look at whether it's EV technology, we're short on copper. It's like uranium, we're short on copper. In fact, we're short on most commodities. So yeah, I agree with that call as well.
Okay, we got to take another quick break here, but when we come back, Brooke Thackeray is going to be taking your questions on First Call. That's right after the break. Stay with us. Welcome back. Time now for our First Call segment with Brooke Thackeray. We're going to go to an email. First of all, this one coming in from Jack, and it reads, "Good morning. I would like your opinion on MDA Space. Thanks." Okay, so MDA Space, a big player in Brampton, Ontario. What do you think about this company?
They're in the right spot at the right time. And I think it's a great place to be because they're receiving all sorts of government contracts right now. So this company is responsible for low orbit satellites here. So we're starting to see a little bit of a pickup here from here. So I think they're in the right spot at the right time to receive government money as a build out.
Okay. We'll move on to another email, this one coming from Jordan. This one reads, "With Trump talking about cannabis, is this the time to buy Canopy?" What do you think? I mean, when Donald Trump speaks, sometimes that helps a company and a stock price. What do you think about Canopy?
So I think Canopy actually makes sense because, Trump right now is, talking about removing marijuana as a Schedule I drug and bumping it down to perhaps a Schedule III. And I think he's going to try and win votes from that coming up because don't forget we got the midterms coming up. So he's going to have to do something to sort of make peace with the other side. So I think there will be something happening there. And I think that will bring excitement back to the sector. And Canopy's really been bouncing along here for quite a while. I think that this will bring some excitement back and Canopy can actually do well from this with the U.S. market.
You think maybe a good time to buy then at the moment?
I think so. I think it actually makes sense, yes.
Okay, we'll move on to another email. This one is coming in from Rich, and it reads, "Good morning. There's been a lot of buzz around Bombardier. Should I hold on?" What do you think about the Bombardier stock and how it's been doing this year?
Bombardier, at this point, I think I would actually have a hold, continue to hold it. I think, like we talked about MDA, it's in the right space at the right time here. So it's done extremely well, so I would be holding on at this point. It's important to let your winners run, not just, hey, it's gone up a lot and therefore I sell. So they're executing at the right levels in the right space. So I would continue to hold this stock. And not, if you don't want to get technical about it, maybe if it does pull back and starts to break resistance lines, you put a trailing stop on it. But at this point, I'd be holding Bombardier.
And there's a lot of talk, even just to start the week this week, about transportation stocks and how a lot of them are doing quite well. I mean, is that a sector you tend to like in particular? So
transportation, you have to break down into different parts, because if you take a look at whether UPS is in the transportation sector in the U.S., and you have trucking as well. So a lot of the transportation sector hasn't done well, and that's actually been a little bit of a concern from investors, saying, well, if the transportation sector isn't doing well itself as a group, the trucking's not doing well necessarily, and we're seeing shipments decrease, then that might be a reflection on the economy. So that's been used in the past, but it hasn't happened yet. But transportation, I think, can do okay at this point, but it hasn't done as well as expected.
We have a little bit of time left. So I know we were talking earlier about technology stocks and investors kind of shifting away from these technology stocks. Are there any other sectors that you find interesting or intriguing, or something you like, that you think maybe investors could shift away from technology and look at instead?
Well, I think we're going to start to see a lot of this depends on the U.S. dollar. If we go back to that, because the U.S. dollar it didn't do well in the first half of this year, and then in the second half it's picked up a little bit, but it's showing some real weakness in November. And if we see it actually pull back here further, I think that this could lead to other parts of the market, not just the U.S. doing well.
Okay. Apologies, I gotta wrap it up. We are out of time. That's it for us here on The Street. Thanks to Brooke Thackeray, research analyst at Global X, for joining us today. Thanks for your time. The Open is next, and the markets will open just over 30 minutes from now. Stay with us.